Welcome to The Bit, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido.
And I'm Stevie Manns, the Biz producer.
We're continuing our summer series with a look back on some of our favorite episodes.
That's right. Last time I picked a favorite, and this time it's back to Oscar for our final episode. So, Oscar, what do you have for us today?
Well, I've chosen the episode with Samara Cohen, which was titled From Savings to Prosperity, the Impact of Capital Markets.
That is a great choice. Tell me why you chose this episode as your favorite.
Well, I thought Samara delivered a masterclass in how capital markets work. And she talks about connecting savers. So it could be individuals like you and I, Stevie, or it could be pension funds, essentially where the pools of capital in the world reside, and connecting those with the entities that need that capital. If you think like governments or companies that are looking to generate economic growth. And I loved how she broke down why transparency, access, and resilience are key to building trust and growth. I also thought it was interesting that at the very beginning, she admits that in doing this work on this paper, that everybody had to take a bit of a pause and make sure that we were working with the same definition of what we meant when we say capital markets. Samara ultimately has, Samara's also very optimistic by nature. At least when I've talked to her, I feel like she has a very infectious optimism about her. And I found her long-term view on capital markets as connective tissue, I think is how she referred to it, as a really fascinating take.
I agree. And I think for so many people who are confuddled, if you like, by what capital markets are, this was such a great episode where you can say to your uncle, this is a great episode for you to check out. Or if anyone is thinking about investing and feels intimidated by it, I thought this was perfect for them.
That's right. So why don't we go ahead and take a listen? Samara, thank you so much for joining us on The Bit.
Thank you for having me.
Samara, we're here to talk about capital markets and the importance that they have to the global economy. It's a term that I think you and I share a lot. We understand what that means, or we use it a lot in our day-to-day. But maybe for some people, this term capital markets is a little bit more nebulous. So maybe let's start there. What do we mean when we say capital markets?
You are so right, Oscar. And this was probably the biggest learning for me in the work we did on this paper was the importance of defining capital markets. And I say this as a multi-decade markets professional myself. I was working with the different definitions some of my colleagues were working with, and just table stakes, sitting down and saying, what are we talking about when we say capital markets? And it just reminds me, you learn when you start a job, there's no dumb questions, ask your questions, and you get to a point in working at a markets firm, you don't think to say, hey, what are capital markets? But I'm really grateful to the colleagues that got around the table with us and said, wait a minute, I think you guys are talking about different things. Fundamentally, what are capital markets? So here's our definition. Capital markets are the connectors between consumers and suppliers of capital. Consumers of capital are companies, countries, governments. Suppliers of capital are people with cash who don't need that cash right now, like savers, long-term investors. So the connective tissue, whether that is a public stock market or an OTC market or increasingly private, bilaterally negotiated transactions, all of that is the how of how we take cash and put it to its most productive use in fueling economic growth. So that is our broad framing of what we mean when we say capital markets.
Right. And connective tissue, that term you use, which is taking the capital that investors have, which could be an individual or it could be a pension fund, and funneling it to the entities that might need that capital for growth, which could be a company or a government, I think were some of the examples that you gave. When we think about capital markets, is there a difference between what they look like, their maturity, their evolution in the developed world, countries like the US, the UK, versus the emerging world, countries like maybe China and India? Is there a difference, or are they pretty similar?
There are huge differences in capital markets around the world, around countries, and even within countries. So to give you a couple examples to bring this to life, if I talk about U.S. capital markets, I think the initial image that comes to mind is the U.S. public equity market, the iconic image of someone ringing the bell at the New York Stock Exchange at the close on CNBC or doing the same on NASDAQ. And those are a specific type of capital market, the public equity market. And the public equity market is pretty mature. Actually, in the U.S., 62% of people in the U.S. are invested in some way, either directly or indirectly through their pension fund, in our public equity markets. But even in the U.S., where we have these deep, mature public equity markets, we have more emerging marketplaces that potentially present more opportunities for investors to participate in, like private equity and private debt markets. Then we can look at an emerging economy which is aspiring to create more of a capital market, like Saudi Arabia, for example. Some of the oil-rich Middle Eastern countries really want to create more opportunities for their people to invest in local and diversified businesses and business endeavors by building stock markets and looking to examples like the more developed stock markets in the U.S. and in Europe to do that.
So it sounds like regardless of whether it's a developed market like the U.S. or a developing market like Saudi Arabia, both of these examples, there's still evolution going on. Maybe in Saudi Arabia, it's just getting people to start investing, to start taking advantage of the evolving capital market regime. And in the developed world, it's furthering that from public to private markets, which is actually a topic that we've been talking about recently. When we talk about just the impact on our day-to-day worlds, you've alluded to this capital being provided to those who need it, who are using it for growth and to grow their companies. But talk a little bit more about how capital markets fuel innovation, growth in an economy.
Really, one of the best examples today is retirement and the opportunity that capital markets presents for retirement savings and savers around the world, because retirement is the definition of long-term capital supply. It is money that someone wants to grow for when they need it in the future. And really, for the past 20, 25 years around the world, people have probably over-relied on bank accounts and bank deposits for their retirement savers. Less so in the U.S. than in other places, but even in the U.S. And importantly, they cannot generate inflation-beating returns with that strategy. So how do they generate inflation-beating returns? They have to invest in some way in economic growth. So if we look at, again, companies, public endeavors, long-term growth opportunities that need capital to fuel them, to fuel expansion, investment, innovation, that is a great matchup of time horizon opportunity and then hopefully return potential for the long-term use of that capital.
Samara, one thing that comes to mind is the banking sector. In many countries, the banks play a big role in terms of financing the growth of an economy. So as we're talking about capital markets, are banks part of this, or is that different from what you're describing?
The banks play a role in capital markets, and at the same time, the role of banks and how it has been evolving is happening alongside the modernization of capital markets. For example, a company can look to finance itself in a number of ways. One of those ways might be to get a loan from a bank, but another way is to actually seek capital from issuing a bond and making that bond available for a much broader group of investors to participate in. Or they can even negotiate a private debt transaction with a larger investor. And that is a different sort of risk transfer from what has historically been facilitated by the banking sector. And if we look at the trajectory of markets and banks over the past 20 years, that's really been where the combination of both regulation and technology has taken us. Post-crisis regulation has required that banks hold much more capital and manage their risk in a much more significant way, which in a lot of ways has reduced bank lending to the market, and capital markets have stepped in to fill that gap.
Right. Companies have a lot of way to finance themselves. It's not just through banks. It could be through issuing stock or debt into the capital markets. And you touched on the regulatory framework, which has had an impact here. So Talk a little bit more about that and maybe just some of the innovation that you've seen in how markets work that is helping with the evolution of the space.
Those two things really live side by side. Technology and regulation together are really the twin forces that modernize a market. So let's look at the bond market as an example. I remember when I first became an investor on my own, and also being the one finance person in my family was the one everybody called for advice on what they should invest in. So even though as like a kid putting my retirement money in equities, I was still the bond person that everybody asked questions around. It was really hard for people to participate in the bond market then because it was hard to get information on bonds. The bond market was largely an institutionally what we call over-the-counter. You couldn't look up information around bonds on your phone. You couldn't buy a bond on your phone. You'd have to go to a broker-dealer, pay a big commission. The bond market was, generally speaking, pretty opaque and inaccessible. So fast forward to today, number one, technology has made all of the difference. Digital platforms, electronic trading of bonds, and innovations like ETFs, which allow people to see on their phone in a way that they can access by looking at any app that looks at stocks, like where different parts of the bond market are trading. It's a level of access and transparency in a different zip code than where we were 20 years ago. At the same time, regulation has evolved to provide really sound investor guardrails, disclosure requirements, education prerequisites to help investors on their journey of participating in this innovation.
Right. So more transparency, better technology, more information. It sounds like it should make it easier for investors to participate in capital markets. But why is that important? Why do we care if more investors are participating in the capital markets? Is that important?
It's important both for investors to have better financial futures, and it's also important for economic growth because growth needs capital in order to fuel it. And companies, countries, governments benefit from having diverse sources of capital, which creates more resilience in how they borrow. But for individuals, really what matters, and this is why in the environment that we've been in the last couple of years, the bond market matters so much more. Like for a long period of time, interest rates were so low, long-term allocations to the market didn't necessarily have significant allocations to fixed income. There wasn't any return. Now there is. There's a lot of volatility in the yield curve, and so having a more active approach to that fixed income portion of a portfolio has never been more significant for an investor than it is today.
And I'm thinking a little bit about what Larry Fink has been talking about in his letter to investors, just going back to the point of the importance of getting investors participating in markets is that there are these structural trends in the world that represent good investment opportunities, things like infrastructure, and that investors have an ability to participate in that growth by investing in these long-term projects. So it goes back to the point of matching the pools of capital where the investors are and those that need capital, which are the entities that are trying to build these infrastructure projects.
Yeah, that's the perfect way to say it, Oscar. In order to create more growth, investment opportunities, there need to be investment opportunities. They need capital, and investors need to have a broader, more diversified suite of investments in order to outperform inflation over whatever their time horizon is.
Let's talk a little bit about areas of the world. We've started talking about this a little bit where maybe the development of financial markets is still in the earlier stages, but what are some of the challenges in these areas where the capital markets are less mature, maybe at a different stage than the U.S. is now or some of the other developed markets are? What do you see as some of those challenges?
Generally, there's three categories of progress in modernizing a market and making it available to a broad group of investors, and that is creating transparency. Transparency is really the foundation of investor confidence. No one wants to participate in a market or take a risk if they can't get information, if they can't see where prices are, if they can't understand and consume basic risk characteristics of what they are investing in. So transparency and data is always foundational to building a market. The next piece is really access. Like, what's your on-ramp to a market? And you and I talked a little bit about the bond market of yore, where it was a phone and finding a broker, but actually being able to have tools that people are comfortable using, increasingly mobile technology that allows you to see the market and transact in the market. That level of access is increasingly in demand today because one of the big trends around the world in capital markets is actually the desire for direct participation, individual investors who want to participate on their own terms and their own time frame in the market. So that access piece is pillar number 2. And then pillar number 3 is really resilience. What are the guardrails around the market, particularly in times of volatility and stress? Because stressed moments in a market can be moments that validate confidence or really undermine confidence in the market. And so what you see, even in the most mature and modern markets, is hopefully never waste a crisis. Like anytime there is something that happens that hasn't happened before in a market, what you see in markets that are continuously transforming is implementing new safeguards and volatility mechanisms. Now, a lot of times in markets that don't have those or are still growing, they just close when there's volatility. But even having a plan in place that is clearly communicated on how and when a market will close is really important to the development of a market. Because again, when you can't access a market and that surprises you, that can undermine confidence. So really thinking about those things together, transparency, access, and resilience, are the core characteristics of building a new market, whether that's in a emerging country or in an emerging ecosystem like the crypto ecosystem. It's the same set of factors there.
And I'm glad you mentioned the word volatility as well, because while we're talking about the long-term benefits of capital markets and how they can fuel economic growth, it doesn't mean they don't go through periods of volatility either. And your point is simply that when you go through those periods of volatility, things like having transparency, having access, having resilience will just instill confidence to stick through those periods of volatility. Samara, what would be the takeaways if you're talking to investors of how they should think about unlocking the full potential of what capital markets can bring?
So, Oscar, we started this conversation by defining capital markets. And I said, as a multi-decade markets professional, that was a good exercise for me. So hopefully a big takeaway for anyone thinking about the markets is that there are no dumb questions. It doesn't matter if you are new to the markets, seasoned in the markets. Markets, at their best, actually are continuously changing and transforming. So number one, having that confidence that the best markets are the ones that the most people can participate in. So the markets belong to everyone, really, and asking those questions is really important. And there's better information now than ever before for investors to really self-educate themselves on their markets journey, including, hopefully reading papers like ours, listening to conversations on the bid, and however you consume your information. I'm a reader, whether you're a listener, but there is a huge amount of information, and the markets are evolving rapidly, and technology is making them more accessible and transparent. So I think there's never been a better time to be an individual investor looking to engage in markets. And ultimately, that actually makes me really bullish for global economic growth because of that connection between investor participation and fueling the biggest opportunities we have around the world.
And so much of investors having confidence to invest is demystifying sometimes the terminology we use and just how things work, which is what you've helped us do today to define capital markets, help us understand the importance to long-term economic growth. And we appreciate you doing that. I'm sure we'll ask you to come do it again at some point, Samara. Thank you again for joining us on The Bid.
Thank you so much for having me, Oscar.
Well, Oscar, when you introduced this, you said Samara gave us a masterclass, and I think you're absolutely right. And not only was the content a masterclass, but I think Samara is one of the best speakers in the business. Did you know that she majored in theater arts?
I did not know that, but now that you mention it, I think it makes sense. She always brings great energy to the interviews that we do with her, and she's always very excited to be in the studio with us. So now I'm starting to understand a little bit of why that is the case.
Well, Oscar, this has been so much fun. Thank you for having me on. I always enjoy coming on and picking our favorite episodes to share with listeners over the summer. So to quote our guests, Thank you so much for having me.
It's been a pleasure. Thanks, Stevie, for joining me in the studio. We'll be back in September with brand new episodes. But until then, thanks for listening to The Bid. And don't forget to subscribe to The Bid wherever you get your podcasts. I'm Oscar Pulido.
And I'm Stevie Manns. This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.